Vice President J.D. Vance has argued that there is a case for viewing America's reserve currency status in a similar way to the resource curse experienced by regions that become dependent on one valuable natural resource. And Treasury Secretary Scott Bessent has also been discussing a return to what he calls Hamiltonian economics. At first, these ideas might sound contradictory. Why would American officials even consider weakening the dollar when the dollar is one of the biggest sources of American power? Why would the United States voluntarily give up the financial advantage that allows it to borrow in its own currency, impose sanctions through the global financial system, and influence international trade? The answer is more complicated than simply saying that America wants to abandon the dollar, because underneath all of this is a much bigger problem. The United States now has more than $40 trillion of national debt. And the issue isn't simply the size of that debt. Debt by itself isn't necessarily a crisis. The real question is how much it costs to maintain that debt and whether investors around the world are still willing to keep lending to the United States on the same terms they did in the past. For roughly 80 years, America benefited from what is often called the exorbitant privilege. The rest of the world needed dollars. And because the rest of the world needed dollars, countries accumulated American Treasury bonds. That created a structural source of demand for U.S. government debt. The United States could borrow enormous amounts of money because there was always a huge global market for those dollars and Treasury securities, but that automatic demand may be weakening. And if it is weakening, the consequences could reach far beyond Wall Street. They could affect interest rates, government spending, inflation, retirement accounts, housing, financial markets, and ultimately the purchasing power of ordinary Americans. So let's start with the basic problem. The United States has accumulated an enormous amount of debt. But imagine you personally had $100,000 of income every year. Having a mortgage wouldn't automatically mean you were in trouble. Having a car loan wouldn't automatically mean you were in trouble. Even having credit card debt wouldn't automatically mean you were in trouble. The question would be whether your income was large enough to cover the payments. The United States faces the same basic principle, just on a vastly larger scale. The government has to pay interest on its debt. And when interest rates rise, the cost of that debt rises. That creates a dangerous feedback loop. Higher rates mean higher interest costs. Higher interest costs mean larger deficits. Larger deficits require more borrowing. More borrowing means more Treasury securities entering the market. And if investors demand higher compensation for buying those securities, borrowing costs rise again. That is the beginning of a debt spiral. And according to the source material, something important is already happening in the bond market. The yield on the 30-year Treasury bond has reached its highest level since 2007. That matters because long-term Treasury yields are not directly controlled by the Federal Reserve. The Fed controls short-term interest rates. But the 10-year and 30-year Treasury yields are heavily influenced by the market. Pension funds, insurance companies, foreign central banks, hedge funds, institutional investors, and private investors all participate in determining the price. And if those investors demand more money to hold long-term American debt, the government has to pay more. That is where the reserve currency story becomes important. For decades, the world essentially provided the United States with a permanent customer base for its debt. Central banks needed dollar reserves, and one of the easiest places to keep those reserves was in U.S. Treasury securities. But according to the source, that automatic bid began weakening around 2014. Central banks around the world increasingly began diversifying away from Treasury securities and increasing their purchases of gold. And that shift is important because it suggests that some countries are thinking differently about reserve assets. Gold doesn't belong to another government. It isn't someone else's liability. It cannot be printed. And it cannot be frozen in the same way a bank account or foreign government asset can be frozen. This brings us to one of the most important arguments made by Scott Bessent. Before becoming Treasury Secretary, Bessent discussed how the United States had increasingly used the dollar as a tool of foreign policy. American sanctions have been imposed on countries including Iran, Russia, and Venezuela. From Washington's perspective, financial sanctions are an extremely powerful instrument, but there is a potential long-term consequence. If countries believe that access to the dollar system can be restricted whenever American foreign policy objectives change, they may eventually decide that relying too heavily on the dollar is itself a risk. That doesn't mean they suddenly abandon the dollar. It doesn't happen overnight. Instead, they begin diversifying. They purchase more gold. They develop alternative payment systems. They reduce exposure to American financial assets. They look for different ways to settle international trade. And that process can happen very slowly. This is what the source describes as slow-motion de-dollarization. But there is an interesting twist. De-dollarization does not necessarily begin with a collapsing dollar. It can begin with a temporary dollar shortage or dollar rally. Companies and countries may need dollars to repay existing dollar-denominated debt. That can create strong demand for dollars before the longer-term process of diversification accelerates. So you can have a period where the dollar becomes stronger, even while the underlying system is gradually becoming less dependent on it. That sounds contradictory, but financial markets often behave that way. And this is where the idea of the resource curse comes back. Consider Appalachia. In the late 19th century, land agents entered parts of West Virginia and Kentucky and purchased mineral rights from farmers for very little money. The farmers received cash. The companies obtained access to enormous coal resources. And that coal became enormously valuable. It powered American industry. It helped power the electric grid. It helped fuel the country's industrial expansion and military capacity. But eventually, much of the wealth generated by those resources left the communities where the resources were located. Outside corporations owned the land and mineral wealth. The resources were extracted. The money moved elsewhere, and the local communities were left without the economic base necessary to replace the wealth that had been removed. That is the resource curse. A valuable resource can create enormous wealth while simultaneously weakening the broader economic structure around it. And J.D. Vance's argument is that something similar could happen with the American dollar. The United States produces the world's dominant reserve currency. Other countries want dollars? That sounds like an enormous advantage. But if the United States can simply create financial assets that the rest of the world wants, there may be less pressure to produce physical goods, build industrial capacity, expand energy production, or maintain other parts of the real economy. The country can become increasingly dependent on finance, and that creates a different kind of vulnerability. One of the examples used in the source is electricity. The United States generated roughly the same amount of electricity in 2024 as it did in 2004. Over that same period, the economy became much larger. That doesn't mean the entire American economy failed to grow. It means a significant portion of the growth occurred in sectors such as finance, software, services, and asset prices, rather than in industries that require enormous quantities of electricity and physical infrastructure. And compare that with China. China dramatically expanded its electricity generation capacity. The source argues that China went from having less than half of America's grid to more than twice its size. Whether you agree with every part of the resource curse argument or not, the strategic question is important. What happens when the world's most powerful currency becomes the most valuable thing the country produces? And what happens when the rest of the world begins looking for alternatives? Because this isn't only about dollars, it's about what those dollars buy. If the dollar loses purchasing power, your investment account can rise in nominal terms while your actual purchasing power falls. That distinction is critical. Imagine your portfolio increases by 20%. That sounds great, but what if the things you need to buy increase by 30%? You have more dollars, but you can afford less. The source illustrates this using gold as an alternative measuring stick. The Nasdaq 100 has risen dramatically in dollar terms over the past several years. But when measured against gold, its performance looks dramatically different. The same argument is applied to the S&P 500. In dollar terms, American stocks have experienced a powerful bull market. But measured against gold, the result is much less impressive. That creates an uncomfortable possibility. Maybe the stock market isn't becoming dramatically more valuable. Maybe part of what we're seeing is the currency used to measure those assets becoming less valuable. And that distinction matters enormously for investors, because when you open your brokerage account, everything is displayed in dollars. If the number goes from $500,000 to $600,000, you feel richer, but your brokerage account doesn't automatically tell you whether your purchasing power relative to gold, energy, housing, or other real assets has improved. That is why inflation can be so deceptive. You don't receive a letter saying your savings are now worth less. Instead, the number in your account keeps increasing, but the things you want to buy keep becoming more expensive. And that brings us to the bond market. Bonds are supposed to be among the safest investments available. Retirees buy them, pension funds hold them, insurance companies hold them, governments hold them. Financial advisors often recommend them as a way to reduce portfolio volatility. But safety in nominal terms is not the same as safety in purchasing power terms. Imagine someone retiring in 2014. They worked for decades. They saved, they invested, and when they reached retirement, they moved their money into long-term Treasury bonds because they wanted safety. They received the interest payments they were promised. The government didn't necessarily default, but if you measure the purchasing power of those bonds against gold, the source argues that the investor could have lost roughly 90% of their purchasing power. That is an extraordinary difference. And it demonstrates why nominal safety and real wealth are not always the same thing. This is why the current situation is so important. The transfer of wealth doesn't necessarily happen through a dramatic event. It can happen over 10 or 20 years. It happens slowly, you earn money, you save money, your account balance increases, but the purchasing power of that money changes. You feel it when you buy groceries, you feel it when you fill your car with fuel, you feel it when you pay rent, you feel it when you try to buy a house, and you may not immediately connect those experiences to Treasury yields or foreign central bank reserve decisions. But they are connected, because eventually the cost of money affects the cost of everything else. Now we arrive at the most dangerous part of the story. What happens when the cost of servicing government debt becomes larger than the government's ability to grow its income? The debt begins growing faster than the economy's capacity to support it. The government borrows more. That borrowing creates more interest expense. The interest expense creates larger deficits. The larger deficits require more borrowing, and the cycle continues. So you might ask, why can't the United States simply print more money? After all, it controls the world's reserve currency. That is where the resource curse argument becomes important again. The Treasury still has to sell bonds. According to the source, the United States has roughly $1.4 trillion of net borrowing to conduct over the following 6 months described in the material. Those bonds have to be purchased. For decades, there were automatic buyers. Central banks around the world needed dollar reserves. But if those buyers become less willing to purchase long-term Treasury bonds, the government has to offer higher yields. The market essentially says, we'll lend you the money, but we want more interest. And if investors demand 5% instead of 4%, that additional cost eventually becomes part of the government's financial burden. Then the next auction happens. Investors see the larger debt burden. They see the higher interest costs. They demand even more compensation. And the ratchet moves again. This is why the 30-year Treasury yield is so important. It represents the long-term cost of borrowing. And according to the source, that yield has reached levels not seen since 2007. The 10-year yield has also risen sharply. And this puts the Treasury in a difficult position because there are essentially two parts of the interest rate curve. There is the short end and there is the long end. The Federal Reserve has enormous influence over short-term rates, but the market has much more influence over long-term rates. So what happens if the government wants to reduce borrowing costs? One strategy is to move more borrowing toward the short end. In other words, instead of issuing as much long-term debt, issue more short-term Treasury bills. This changes who ultimately controls the cost. The Federal Reserve has much more influence over short-term interest rates, and the Treasury can refinance debt as those short-term securities mature. But there is a major risk. You are effectively shortening the maturity of the country's debt. Imagine you have a credit card balance that would normally be paid over 10 years. Instead, you refinance it with a bill that comes due next month. You've moved the problem closer. You may have gained flexibility, but now you have to refinance much more frequently. And if interest rates are high when you refinance, your costs can rise quickly. According to the source, the Treasury has been increasing its reliance on 4-week Treasury bills. The amount issued per auction has roughly doubled compared with the earlier period discussed. And the source argues that the Treasury is also using buybacks to reduce some long-term debt and replace it with shorter-term issuance. This is a significant strategy, because long-term Treasury debt locks in its interest rate for decades. Short-term debt doesn't. If the Federal Reserve eventually lowers rates, the government can refinance that short-term debt at a lower cost. That is the potential benefit. But it also creates dependence on future monetary policy. And that leads to the next question. Who is going to buy all of those short-term Treasury bills? If foreign governments are becoming less enthusiastic about U.S. debt, America needs another enormous buyer. And this is where stablecoins enter the story. Stablecoins are digital assets designed to maintain a stable value relative to currencies such as the U.S. dollar. Under the framework described in the source, stablecoin issuers would need to hold reserves backed by short-term Treasury securities. That creates a potentially enormous new source of demand for U.S. government debt. And there is an interesting feature of this buyer. Someone in a country experiencing severe currency instability may not care about earning a high yield on their dollars. They simply want access to dollars. They want something they believe will hold its value better than their domestic currency. If they hold a dollar stablecoin earning little or no interest, that may still be preferable to holding a rapidly depreciating local currency. So imagine millions of people around the world holding digital dollars. Behind those digital dollars are short-term Treasury securities. The result could be a new global demand channel for U.S. government debt. And that could be part of the strategy for maintaining dollar dominance even while traditional foreign central bank demand weakens. This creates an interesting contradiction. On one hand, the United States may be experiencing slow-motion de-dollarization among foreign governments. On the other hand, it may be attempting to expand the dollar's reach among individuals and financial institutions around the world through digital dollars. The dollar could therefore become less dominant in one part of the global financial system while becoming more deeply embedded in another, and that may explain why the administration is so interested in stablecoins. But then we reach the final part of the strategy: inflation. If the government can borrow at a relatively low short-term rate while inflation remains above that rate, the real value of the debt decreases over time. Imagine you own a bond paying you 2%, but inflation is 6%. You receive every payment you were promised. Your account balance doesn't disappear, but your purchasing power falls. Economists call that a negative real interest rate. And from the government's perspective, negative real rates can reduce the real burden of debt. This isn't necessarily a dramatic default. It is something much quieter. The government pays you back, but the money it pays you back with buys less. And the historical example discussed in the source is the period following World War II. The United States had an enormous debt burden relative to the size of the economy. Over the following years, that debt burden declined dramatically. And the source argues that negative real interest rates played an important role in transferring the cost to bondholders. The broader American economy expanded, but people holding government bonds received returns that did not necessarily keep pace with inflation. That distinction is extremely important, because when we hear that the United States has never defaulted on its Treasury debt, that is technically reassuring, but there are different ways to lose purchasing power. A country doesn't necessarily have to refuse to pay you. It can pay you in money that is worth less than the money you originally lent. And that brings us all the way back to J.D. Vance. Remember the resource curse. The argument isn't necessarily that the dollar is worthless. The dollar remains enormously powerful. The argument is that America's dependence on the dollar's reserve status may have encouraged an economic structure that is increasingly dependent on finance rather than physical production. If the United States wants to reverse that trend, it would need to encourage more manufacturing, more energy production, more infrastructure, more industrial capacity, more electricity, more physical investment, more things that increase the country's ability to produce real goods and services. That would be a fundamentally different economic model. But the strategy described in the source points in almost the opposite direction. Instead of abandoning the dollar, it attempts to extend the dollar system. Instead of reducing dollar demand, it seeks new sources of dollar demand. Instead of allowing foreign central banks to be the only major buyers of Treasury debt, it could create millions of new dollar users through stablecoins. And instead of immediately confronting the enormous long-term debt problem, the Treasury could continue moving debt towards shorter maturities while waiting for interest rates to fall. That could buy time. But buying time is not the same thing as solving the underlying problem, and that is perhaps the most important point in this entire story. The United States is not simply facing a dollar crisis, it is facing a choice about what kind of economic system it wants to have. Does America want to remain the world's financial center, using the dollar to attract global capital and finance enormous government deficits? Or does it want to rebuild more of the physical industrial economy and reduce its dependence on financial privilege? Maybe the answer will be some combination of both. But the transition could be extremely difficult, because every part of the system is connected. If the dollar weakens, imported goods become more expensive. If Treasury yields rise, government borrowing becomes more expensive. If the Fed lowers rates aggressively, the dollar could weaken further. If the Treasury relies more heavily on short-term debt, it becomes more exposed to future interest rate movements. If foreign central banks buy less Treasury debt, private investors must absorb more issuance. If stablecoins become a major source of Treasury demand, the dollar could become even more deeply embedded in global finance. And if inflation remains above interest rates, bondholders could absorb the real cost. Someone pays. That is the unavoidable part. The question is simply who. It could be taxpayers. It could be consumers through inflation. It could be bondholders through negative real returns. It could be investors through lower asset valuations. It could be future generations through larger debt burdens. Or it could be some combination of all of them. And this is why the bond market matters so much. The bond market is where the world votes on the price of American borrowing. Every Treasury auction is a vote. Every foreign reserve decision is a vote. Every interest rate move is a vote. Every gold purchase is a signal. Every dollar transaction is part of the system. And when investors start demanding more compensation, Washington has to respond. It can raise taxes. It can cut spending. It can grow the economy. It can allow inflation. It can rely on monetary policy. It can issue shorter-term debt. It can encourage new sources of Treasury demand. But every option has consequences. There is no magic button. And that is why the discussion about ending the dollar's reserve currency role is much more nuanced than it first appears. J.D. Vance may not necessarily be arguing that America should destroy the dollar. He may be arguing that America should stop depending on the dollar as its primary economic resource. Scott Bessent may not necessarily be trying to abandon the global dollar system. He may be trying to preserve it by adapting it. And stablecoins may not simply be a cryptocurrency story. They could become part of the architecture of future Treasury demand. At the same time, countries such as China and other central banks may continue diversifying reserves. Gold may continue becoming more important. And the global financial system may slowly become less dependent on a single reserve asset. That doesn't mean the dollar disappears. It means the world may be moving toward a more complicated monetary system, one where the dollar remains dominant but no longer stands completely alone. And that transition could take years, maybe decades, which is why most people won't notice it happening. There probably won't be one morning when everyone wakes up and the dollar is suddenly no longer the world's reserve currency. Instead, you may see small changes. A central bank buys more gold. A country reduces its treasury holdings. A company settles a transaction in another currency. A new payment network emerges. Stablecoin usage expands. Treasury yields remain elevated. The government issues more short-term bills, and gradually, the architecture of global finance changes. That is what makes this story so important. The biggest financial shifts rarely happen in one dramatic moment. They happen slowly, and by the time the average person notices, the underlying system may already be very different. So when you hear that the United States has a $40 trillion debt burden, don't only ask whether America can pay it. Ask who is willing to finance it. When you hear that Treasury yields are rising, don't only ask whether inflation is high. Ask whether investors are demanding a higher risk premium. When you hear that central banks are buying gold, don't immediately assume the dollar is collapsing. Ask what those governments are preparing for. When you hear about stablecoins, don't only think about cryptocurrency. Ask what happens if millions of people around the world begin holding digital dollars backed by short-term Treasury securities. And when you hear someone say that the reserve currency is a privilege, ask the next question. A privilege for whom? Because that may be the central debate facing the United States. The dollar gave America extraordinary power. It allowed the country to finance itself cheaply. It allowed Washington to impose financial sanctions. It gave American markets enormous influence. It helped make U.S. government debt the world's benchmark safe asset. But every advantage has a cost. The more the United States relies on financial demand from the rest of the world, the more important that demand becomes. And if that demand changes, the system has to adjust. Maybe the United States can successfully adapt. Maybe new Treasury buyers through stablecoins can replace some of the demand lost from foreign central banks. Maybe inflation can reduce the real debt burden. Maybe interest rates eventually fall. Maybe the American economy rebuilds enough industrial capacity to support the debt. There are many possible outcomes, but one thing is clear. The old assumption that the rest of the world would automatically absorb unlimited amounts of American debt cannot simply be taken for granted forever. The market is demanding evidence. Investors want compensation. Foreign governments want diversification. Central banks want assets that cannot easily be controlled by another government. And America wants to maintain the financial system that has given it extraordinary power for generations. Those objectives are now colliding, and that collision is what we are watching in the bond market. The story isn't simply about a recession. It isn't simply about inflation. It isn't simply about the dollar, and it isn't simply about America's debt. It is about all of them interacting at the same time. The United States built an empire of financial trust. Now that trust is being tested, the question isn't whether the dollar disappears tomorrow. It won't. The question is whether the world continues accepting the dollar on the same terms. Because if the terms change, everything changes with them. Interest rates, debt, inflation, asset prices, retirement savings, government spending, global trade, and America's ability to project economic power. That is why the bond market deserves your attention. Not because every rising yield means a crisis is coming, but because the bond market is where the cost of America's promises is determined. And right now, that cost is becoming harder to ignore. The dollar may still be the world's most important currency. The United States may still possess extraordinary economic and military power. And American financial markets may continue to attract enormous amounts of global capital. But the era of automatic demand may be changing. And if that is true, then the United States has a choice. It can try to preserve the existing system by creating new buyers, expanding the dollar's global reach, and moving debt toward maturities that policymakers can influence more directly. Or it can attempt something much harder, rebuild the productive economy that sits underneath the financial system. More factories, more energy, more electricity, more infrastructure, more industrial capacity, more real production. Because ultimately, money is only as powerful as the economy behind it. And that may be the real message hidden inside the resource curse argument. The dollar itself isn't the enemy. Dependence on the dollar can become the problem. And if America wants to remain powerful for another generation, the challenge may not be protecting the dollar at all costs. The challenge may be building an economy strong enough that the dollar doesn't have to carry the entire system by itself. That is the debate now unfolding, and the decisions made today may determine what the American financial system looks like years from now. The world isn't necessarily abandoning the dollar, but it is questioning the terms of the relationship. And when the world's largest borrowers and lenders start renegotiating those terms, the consequences can be enormous. So keep watching the Treasury market, watch the 30-year yield, watch foreign central bank purchases, watch gold, watch the dollar, watch stablecoins, and watch what the Treasury does with the maturity of America's debt. Because these may look like separate stories. They aren't. They are pieces of the same puzzle. And somewhere inside that puzzle is the future of the dollar.